Good morning and good afternoon to all of our attendees. Thank you for joining today's Family Office Network's webinar series, Data to Deals Multifamily Acquisitions. Joining us from the offer team is Travis Fries, David Lupke, and Greg Cooper. I'm going to take a short minute to introduce them before we get started. Travis is an engineer, MBA, entrepreneur, investor, and visionary. After selling his last company in 2015, he has become a successful angel investor and tech entrepreneur, shaking up the commercial real estate acquisitions world. David is a commercial real estate veteran with over 17 years experience focused on acquisitions, depositions, development, and portfolio management. David led national coverage of over 1 billion portfolio strategic realignment for the Real Estate Investment Office of Diane Hendricks, where he spent over 13 years of his career. And lastly, Greg. Greg is an attorney by training and a commercial real estate broker by trade. He has built and run several real estate firms and is a proven team builder. He has been developing systems and strategies to uncover off-market deal flow for over a decade and has over 1.5 billion in real estate sales. At the end of our presentation, we will have time for Q&A, and we always encourage your questions. Please use your questions chat option on the right side of your screen to submit all questions. Gentlemen, I will let you get started.
Thanks so much, Lindsay.
Just make sure you're unmuted.
Can everyone hear me all right? Great. Well, welcome to a presentation about Offered and about what we're creating here, which is this new segment we call third-party acquisitions. We're joining you here from Austin, Texas, which is quickly becoming Southeast California. But in today's presentation, we'll talk about the company, what is acquisitions as a service, take questions after the presentation, and then David will be giving a demo of our technology. So who are we? Offered is a technology, services, and investment firm focused on first the $185 billion multifamily acquisitions market, and later all of commercial real estate. You know, when I think about company formation and I think about business in general, we think about what problem are we looking to solve, and is that problem important enough? Is that pain point deep enough? And I can say, being a multifamily investor, commercial real estate investor myself, that the number one problem in multifamily investing and commercial real estate investing, private equity investing, is finding deals. And the current state of the market is that within multifamily commercial real estate and generally, most firms are all running the same playbook. They have an in-house acquisitions function. They are focused solely on a few different markets throughout the national ecosphere, hardly leveraging technology. And as multifamily continues to outperform, and we've seen this throughout the pandemic, coming out of it now today, multifamily has done really well. Capital continues to pour in. And multifamily as an investment asset class has continued to be more and more competitive. So what is that solution? The solution is a tech-enabled commercial real estate investment firm that partners with top operators across the country. I'm going to minimize that. To achieve national scale and reduce risk. So we're taking technology, we're taking data, we're taking analytics, we're deriving insights on where the best markets to invest, what are the best assets to go after for a particular partner, and then deploying that strategy amongst our in-house team of acquisition professionals. We've got 10 internal folks on staff today, growing very quickly over the coming months and year to about 30 within the next 18 months. So if we go to the next here. So how does our partner platform work? As I mentioned, we first take your investment criteria, partner X. Let's just use one of our partners on the West Coast, a multi-generational developer looking to deploy capital now into market rate multifamily, looking to buy stabilized A-class assets that are getting to a 5 cap within the first 12 months, over 30 million under 50 million in markets that have greater than 1.5% population growth and a median household income on average in the tract sector over $100,000. We can do that, and we can target and identify those particular assets that meet those particular precise criteria. And then we take that and we deploy that and we chew that down within our internal acquisitions services function. And the result is an order of magnitude of deal flow, qualified deal flow, pre-qualified deal flow, and ultimately more transactions closed, deploying more capital. So as I mentioned, multifamily is 192 billion. We're focused there first because it is the largest commercial real estate sector, and even in 2020 remained that case. And you can see here that it goes multifamily, and then office, then industrial, retail, and then finally apartment. And so acquisitions as a service, leveraging a tech-enabled firm like ourselves that has a national reach, that service is not only needed amongst multifamily investment firms, but amongst investment firms across all the various commercial real estate asset classes. And we intend to go there within the next 3 years. Our current and our future platform, let's talk a little bit about the technology. Here's a snapshot of our platform, our data visualization, analytics, and the tool that allows us to identify those target assets with such precision. And this is what David will demo at the end of the Q&A session. So we find markets, we find assets using our platform here. We have roughly about 10,000 different demographic layers that we can access through our partnership with Esri. We've developed in-house models around valuation, around value add, and around probability of selling. So this is something that we're tying back our thousands of phone calls that we're making on a monthly basis to iteratively define what are those attributes algorithmically related to the seller's profile, related to their portfolio, all of the data which we do have that makes them likely to transact within the next coming months or within that given year. So we have a model that allows us to identify assets, but also allowing us in closing the loop around not only just insight, but turning those insight into deals. And so utilize our platform to analyze and engage our team around those various attributes that I just mentioned here. As you can see here, we have a value add filter on that is identifying assets that are medium and high value add. We have a deal that we just closed 2 months ago that is reflective of this exact process, and another $49 million deal under contract today, 175 million sourced over the last 2 weeks. And so our process and our algorithms are working. We find that our valuation model is accurate to within about 5% and is the best in the industry. Our V2 platform more tightly integrates our services and our technology into one cohesive platform to allow us to search, identify, target, deploy campaigns, and communicate amongst the various stakeholders, our partners, our internal team, bringing all of the data and the communications and the research into one platform. What is our revenue model and what does our traction look like to date? Our revenue model is unique and powerful in that we have upfront revenue, recurring revenue, and long-term revenue. And so the upfront and recurring component is related to our retainers and our technology fees. Once we launch our V2 platform, we intend to license our technology exclusive from our services. The sourcing fees, which are related to our acquisition services, are strong. For example, the $49 million deal that I mentioned earlier that we will be closing within the next couple of months is $750,000 worth of fees. We have in our partnership, and that third component, which is that long-term revenue component, gives us the ability to place up to 30% of the LP capital in any opportunity that we source at a low or no promote basis. So it allows Offered to act in a general partnership capacity within these opportunities that we are now sourcing across the country and leveraging the local market based expertise for our partners to operate. So our trailing 12-month partner growth, starting in March, right at the beginning of the pandemic, and on the heels of our launch in early 2020, started to bring in our first partners. And for a couple of months there throughout the summer, it was slow due to the pandemic. But as soon as we got into Q3, we have seen a resurgence of demand. Multifamily has continued to outperform, and we are on a very strong partnership growth rate. And so we do anticipate being at about 30 partners by the end of the month, focused in multifamily only. That current deal demand across those 15 partners is about $1 billion in total deal demand. That our job is to fill that demand, and we are. And as I mentioned, we'll be growing to about 30 multifamily partners by the end of the year. We've grown our organization and our headcount 2x in the last 2 months, and we'll continue to do so to fuel and supply the demand created by those 30 partners. What does our revenue look like on a trailing 12-month basis? So this is looking backwards from April. We have about 2.5 million in net present value revenue. When I say net present value, I'm taking the future promotes of the investment opportunities that we have closed into account, discounting it back to present day. So we've done roughly over 600,000 in recurring revenue year to date, about close to 300,000 in fees, 1.5 million in current present value promotes, and about 150,000, which actually will be reflected in June of realized promotes on some of our earlier smaller deals. So what does our 2021 revenue forecast look like? And here we are sitting in May and looking forward with a pretty clear picture on what our pipeline looks like. As I mentioned, we have about 100 million of half of which is currently under contract, the other half which is in late stage negotiations. We just submitted about 100 million of LOIs just this last week, one $80 million portfolio in the Southeast. And so that 4.5 million of revenue is based upon 135 million in total acquisitions. And given our current pipeline and our projected growth throughout the end of the year, feel very strongly that we can get there. So I mentioned that 4.5 million is 134 million in acquisitions. You can see the breakout of the fees, the retainers, the technology fees. As I mentioned, we launched our V2 platform in June and start licensing it as a standalone analytics platform, services sold separately, and our investment fees, placing our 30% allocation into these deals and promoting that capital, charging appropriate asset management fees and the like, and building that over time. And so what does that look like moving forward? We are looking to grow to about $500 million in acquisitions in 2022 and knocking on about 900 million in acquisitions by 2023. That seems like a lot, and that seems like a pretty strong growth pattern. But let me put that into context in terms of the broader multifamily market. We just saw 96 odd billion in total transactions. We have a friend, for example, that runs a CBRE office in Albuquerque, New Mexico. That office alone does $500 million in multifamily transactions. And so with knocking on 30 partners by the end of 2021 and growing that, doubling that every year through 2023, getting very close to $1 billion is a very realistic goal. What does that cash flow look like? One of our core tenets is profitable growth. My first company that I founded was in the oil and gas services space. We capitalized it with $2 million of our own money and sold it for $36 million in 3 years. We were profitable within the first 2.5 months. And so I've engineered an organization and a headcount and expense model that ties revenue and expenses. Most of our VPs, our compensation is highly tied to transactions. That's just how it works. And so I've taken fixed expense and turned it into a variable expense. The firm retains about 60% of the fee revenue. 40% goes to the acquisition side. And then from there, we have very manageable overhead. Our engineering expense, for example, we've leveraged a platform that allows us to more or less leverage one engineer to about 5. And so software development has increasingly become less expensive. Being an engineer, but technophile myself, have really just found a way to build a business that generates strong returns. We are profitable year to date and intend to be moving forward, and would like to raise some capital, a modest amount of capital, to support that growth moving forward. So what do those cash on cash returns look like? As I mentioned, this is our second equity raise. We've only raised $1 million to date. This next raise will be an incremental $1 million at a $25 million pre-money valuation. Based upon our projections, our pipeline, what does that translate into in terms of cash on cash returns? Offered as a company, as a profitable company, we'll distribute cash back. That's how I intend to get paid. And so we're building an organization that is financially strong, is kicking off operational and net cash flow, and also has an enterprise terminal value. By developing this third-party acquisitions as a service, and the model and the recurring revenue, the fee revenue and the equity placement, we feel very strongly that we have very good exit potential within probably year 4 or 5, should we want to do so. Let's look at an actual deal. Deal we just closed in February of 2021. It was a smaller deal, about $10 million in total acquisition price and CapEx, but that translated into about $290,000 worth of fees. We ultimately were asked by the partner to, and were allocated more of the deal and invested about half of the capital, therefore taking about half of the promote, which is equivalent to about $1.5 million over a 5 to 7 year hold, and technology fees of about $36,000 annually. This partner is up for renewal this month. It will absolutely be continuing that partnership, and in fact, we have a $16 million deal with the same partner that we are in active negotiations on. And must add, how did the technology tie into this particular deal? Well, this partner was looking to expand into the Denver market and the Rocky Mountain market, the Colorado Springs included, looking for heavy value add opportunities. And so these are opportunities that with a CapEx investment, you can boost the rents significantly. Our algorithm identified this as a high value add opportunity. And sure enough, when we got the T12 and the rent rolls, connected with the ownership and did our market analysis, it confirmed it. And so the gross returns on this investment is about a 24% internal rate of return over a 5 to 7 year hold. And we are within the 3rd month of executing on that. I've rehabbed about 10% of the units, and we'll continue to do so over the next 18 months. Our partner, that is, offered as a passive GP. Our leadership team, we've grown our headcount, and I'll talk a little bit about our leadership myself. I'm the founder here, really scratching my own itch. When I exited the oil and gas space in 2015, I started to invest in multifamily myself. I still have a portfolio of assets across the country, and I've partnered. I've been a general partner in a number of deals, and so this pain point around the fact that brokerage services currently only service in commercial real estate one side of the transaction, that's the sell side, that there was no third-party acquisitions services out there, if you will. And so I set out to build that. I set out to take the plethora of data that is out there in the multifamily space and commercial real estate, turn that into actionable insight, and combine the services needed to turn those insights into deals. And then David Lupke, our CEO and co-founder, my right-hand man, $500 million of transactions, worked for Ken and Diane Hendricks Family Office in Beloit, 18 years in the industry. Alex, he's down the hall from me at the moment, but he's neck deep in the development of our V2 platform, so not here today. And then Greg Cooper, our president of acquisitions, really running the services side and building out our processes, our people, and that allow us to turn those insights into deals. What does the rest of our team look like? You can see here that we have a number of VPs of acquisitions. We'll be growing this to 10 within the next 90 days. Steve and Regina leading our sales. Steve coming from he was one of the first sales guys at Axiometrics, if anyone's familiar with that company. It was acquired by RealPage. And Regina, just a tremendous salesperson in multiple different enterprise SaaS and surprisingly real estate. And Nicole Cobb, our director of operations and marketing. A couple testimonials, happy to share these offline. Ultimately, we deliver, and all of our clients partners have continued to stay with us as we start to have our first renewals. So the fundraising, the capital structure looks a little confusing here, but basically the investment is into Real AI Technologies, which is a holding company doing business as offered. We went through a rebrand in early 2020, that's where we are, which owns 100% of Real AI, where the technology and the services run, and 100% of the investment arm. Those folks that want to invest directly into our partner deals can register at offered.com/invest and join our investor list. Or those interested in investing in Offered directly have exposure to not only just technology and SaaS, but exposure to fees that are very profitable, but also long-term exposure to real estate on the GP side. Just a note here on the audience presenting to the family office networks, and I continually hear the need for family offices and the desire to go more direct, right? And kind of cut the sponsor out, if you will, and allow family offices to do what they do and deploy capital directly into real estate. Well, the problem is that building an acquisitions arm is challenging. Developing those relationships, that deal flow takes time, expertise. And so we really believe that Offered has a compelling solution for the family offices out there looking to deploy capital, but looking for more direct deal flow. So I encourage anyone on the call today or listening to this webinar now or in the future that fit that profile can go to offered.com and just request additional information and be happy to discuss partnerships around acquisitions as well. That's the end of my presentation. Again, I'm Travis Faris. It's my contact information on the bottom left. And I'd be happy to take any additional questions we might have this time. Once we're done with Q&A, we can transition over to a live demo of the technology.
Travis, thank you so much. Yes, gentlemen, let's jump right into Q&A here. First question, we're just going to dive right in, is what if we have an off-market asset to sell? How would they get exposure using your platform?
Yeah, great question. We love that, of course, that we see Offered as a conduit to transact directly, right? What is the benefit of selling through Offered and not through a brokered process? Well, the biggest one is we don't charge sell-side fees. There is no sell-side fees. And so with an abundance of data and information and sophistication, folks know what their asset is worth. And so that can be done just by simply contacting us. I think later this year, we'll have a direct portal that allows would-be sellers to upload some information. But the best way is through our contact page on our website. Again, we can get at a price very quickly, return that around, and we've done many deals in that capacity.
Perfect. Next question. How does your platform address any pain points from family offices looking to invest in multifamily real estate?
Yeah, thanks. As I kind of was riffing on the last slide, family offices are capital allocators, and capital can be allocated, amongst many different asset classes, real estate, being an attractive one. And so those folks looking for direct exposure to multifamily, and that is buying an asset and being their own general partner, operating the asset. Because remember, you can hire a third-party property manager. You can even hire an asset manager. The equity is already there, but what's really missing is that acquisitions function. And building that out internally, takes time and expertise and expense, data subscriptions, people, travel, and then time. And the results are, are ambiguous. And so I think Offered fills that tremendous gap, and not only as front of the funnel sourcing, but in that advisory perspective as well, leveraging data and our professionals internally, for $36,000 a year is the upfront risk, which we credit back actually against our future success fees. And so we really see it as a low friction, high probable way to start doing deals directly for the family office world.
Great, Travis. And can you tell us a little bit about your take on why multifamily today and in the future is an attractive asset class to invest in?
Yeah. Well, let's talk historically. Historically, and in general, and we've just seen this play out throughout the pandemic, there's a couple of attributes that make it multifamily extremely attractive. Number one, I'll just say is multifamily, you can't disrupt housing. You can disrupt office, you can disrupt retail. We've seen this. You can disrupt industrial, although industrial is on a tear due to the transformation from retail, from the brick and mortar to online. But multifamily has just been solid. Demand has been solid. And we are just fundamentally undersupplied here in the United States for housing. And throughout this pandemic, we've seen that supply-demand imbalance be magnified, and so prices are on a tear. Here in Austin, real estate prices have climbed at least 20% in a year, and with about half a million, single-family homes available for sale today, and builders only building about 500,000 a year, which is about half of historically where they've been. That demand and supply demand imbalance continues to persist. And so, renting just again, out of necessity, becomes more and more attractive, and that puts upward pressure on rents. Upward pressure on rents means increased value for multifamily assets.
Perfect. Next question. Does the platform or team have any oversight by FINRA or the SEC?
No, we've been very thoughtful about how we organize our business. FINRA, no. All of our offerings and our investments are exempt offerings. So they're 506B offerings to accredited investors only. So on the investment side, that puts us outside of the purview of the SEC or FINRA, and that's a well-worn path there.
Great. And can you tell us a little bit about who your competitors are?
Yeah, competitors. It depends on how you define competitors. Is there anyone out there today that has developed a third-party acquisitions firm? No. How are acquisitions done today? Well, historically, acquisitions are done in-house. And so that means hiring a VP of acquisitions, a team, an analyst, so on and so forth. And so I'd say that would be, in a way, our competition. But as a service, we currently don't have any competition. And that's our kind of our little secret, if you will. And I think a good antidote is it's needed here. And I'll go to the brokerage services. Tenant rep. Tenant rep is where a broker helps a company or an individual find office space. It's kind of like buy-side services, if you will. Now, we're not a brokerage. We operate in partnership, But that didn't exist prior to 1990. Staubach, Richard Staubach, I think he's a former football player, invented that. He invented that service, and he built a firm around it, and he sold it to CBRE for $750 million. And so we just think it's crazy that in multifamily and commercial real estate that there is no robust buy-side services in the investment sales space. Investment sales being, buying assets. And so we're going to create that category and do it in not the 1990 format, but in the current format, leveraging technology, AI, data, and integrated services, remote. We can do all that because all of that technology is here.
Great. And would you mind giving us a high-level overview of what a typical, who's your typical client and what size that they would be, and how many deals have you guys closed to date?
Yeah, so our typical partner varies from probably $4 billion to $5 billion in assets under management down to more of like a regional syndicator. And our average acquisition size is about $30 million. We've closed half a dozen transactions, not including the ones that are currently under contract at the moment and in the pipeline today.
Perfect. And can we talk a little bit about challenges? What do you see the biggest challenge that you face today would be?
The biggest challenge, running a business is a challenge every day. I think that, thoughtfully growing is and ensuring that we don't accelerate past what we can service. And what I mean by that, and we're building the technology that enables that, is that growing our partnership base thoughtfully, our services business thoughtfully, and then how do we? Because we are, as a company, it seems from the outside we're doing a lot, but we're executing on that, right? We have services, we have technology, and we have investments. Those three prongs, and that's a lot for any company to take on. But they're all related in the same segment. And I think just for me, over time, I just think about how to more tightly integrate that, and of course, scaling up. We want to be at $1 billion within 4 years. That's totally achievable. You just do the math backwards. How many VPs of acquisitions does it take to do that? Well, probably about 30. How many partners does it take to get there? Maybe between 50 and 100. And so when you distill it down into those real tangible type of numbers, we're not commercial, we're not consumer internet. We don't need billions of users. Each one of our partners is highly lucrative. So I just think about future growth and just getting down to the brass tacks and down to reality on what type of resources we need in order to get there.
Perfect. David, let's jump into the demo here. I'll keep my eyes out to see if any other questions come through, and we can get to those after if we have time. Does that sound good?
Sounds great. All right, I'm going to share my screen now. And Travis, Greg, can you confirm you see our application?
Confirmed.
Great. All right, hey everyone. Thanks for attending today and your time and interest. This is our client application that I will be demoing. I'm going to give you our standard prospective client demo that we would give somebody that is interested in working with Offered. Just gave one this morning to a top 75 owner based out of Miami, and I'll run through it just like I did for them. Happy to do this with any of you after this call, because I'm going to go through it pretty quickly. I don't want to bore you, but just a interesting side note, perhaps, that client, prospective client, came to us through some of our outreach efforts. Yes, they get some of our marketing materials, but just this week, Greg and his team reached out to them about an asset that they own in Orlando, and they became very interested in what we're doing. It's a multi-generational family office, and really their grandson, who's an analyst, was most interested in our software, and he was blown away by it. The grandfather, the founder, chairman, CEO of the company, as well as the executive VP of investments were also there. They were blown away by the idea of getting deal flow the way that we provide it. It just doesn't exist today. So zoomed out here nationally, I'm going to show some layers that might be of interest from the national perspective. We give this application to our clients to use it however they wish, and it can be very useful in the identification of areas to invest in. Also, specific properties to invest in, given the data and intelligence that we have. So nationally here, I'm going to show the COVID-19 most affected counties layer. This is from an economic perspective, ranking each county in the country for its vulnerability to the pandemic. Again, from an economic standpoint. We can see the legend over here telling us that the red counties are more impacted by the pandemic, the gray counties less so, where you might expect Las Vegas, more red. And we can click on any county and any geography in most of our layers to get more details, in this instance showing the breakdown of employment by industry and how that score was developed. Hopefully we can put that one on the shelf again here soon for another 100 years, but perhaps always of interest here is USA population pressure. Looking back in time, historically, over the last 5 years, areas that have grown faster than the national average rate, those are the green dots with a higher concentration, meaning higher net migration to those areas where you might expect the Southeast, Texas, the Smile Belt. The blue dots are areas that are growing right in line with the national average rate of just under 1% per year. The magenta dots are areas that are losing population historically. Now, conversely, looking forward in time over the next 5 years, what areas are expected to grow the fastest? The darkest green counties are projected to grow the fastest annually. The brown and tan colors are expected to lose population. Now, I'm going to zoom into DFW, the hottest market of 2020 from a transaction volume standpoint, and so far in 2021 as well. So I'm going to zoom in here slowly, and we'll see it adjust from the county level to the zip code as we zoom in. There we go, looking at zip codes now. Again, we can click on any zip code to get full details of the expected rate of growth in that particular area. As we zoom in further, it will adjust to the census tract. So even a more targeted area to understand what the growth is in each pocket or each census tract. We can zoom in even further to see what the expected growth is in the block group to get hyper targeted to understand what areas are expected to grow or perhaps lose population. Now that we're zoomed into Dallas, I'm going to show some layers that might be of interest from this local perspective, such as average rent growth over the last 1, 3, and 5 years. We can identify the pockets that have seen the highest rent growth or have seen rent declines just over the last year in this instance. We can also look at this from an occupancy standpoint by zip code, identifying the areas that have higher average occupancy, the darker purple colors, or lower average occupancy, the lighter colors. And just clicking on any of these, we can see full details. What this is telling us is the count of points or the number of 50+ unit assets in that zip code. We're tracking each and every one across 136 markets across the country. So there's 42 multifamily assets in this zip code, 50 units and greater. This is the average year of construction, current occupancy, current average rents, and then we can see the rent growth as well over the last 1, 2, 3, 4, and 5 years. We can quickly identify median home value and income by tract in this instance, or we can zoom out to see it by zip code or county. We can quickly identify the projected annual growth rate of household incomes, where the darker colors are indicating a higher average growth rate in the years ahead. Areas that might support higher rent growth at multifamily assets. Jobs proximity index. ranking census tract by census tract statewide for proximity to major job centers, with the lighter colors being closer proximity, the darker colors being further away. School proficiency, sometimes an important measure to our clients. Good schools. The darker purple colors have higher proficiency schools. The lighter colors have lower proficiency schools, measured census tract by census tract statewide. We can quickly identify opportunity zones for some of our developer clients. Predominant population by race, transit access, crime index, predominant occupational classes. This might be an interesting one. This is showing the breakdown of population that are in creative class jobs, which are relatively higher paying, such as computer science, engineering, and finance jobs, service class, and working class. We can quickly identify flood hazard areas, maybe areas to stay away from. And then our clients have access to over 10,000 different data layers here. We can quickly identify Fortune 1000 headquarters, for instance. We can quickly find hospitals and understand their size and specialties, number of beds, etc. Universities and their enrollment and faculty, the campus boundaries, road construction, sidewalk construction, tech employment. The layers are limitless with 10,000. We're just scratching the surface alongside our clients. Now I'm going to show all of the properties, all of the multifamily properties in the Dallas market here. These are all of the gray dots. Separately, we track the on-market properties, which you can see here, the blue dots. That's about 2% of the inventory nationally. We have the largest aggregation of on-market properties in any application. Separately, we have the rest of the inventory, the other 98%, and that's really what we focus on for our clients in dedicated proactive sourcing campaigns. I'll just click on one of these at random to show some of the details that you'll see in the property data card. We get quick access to the website and the best photos of the property, third-party leasing website, bird's eye aerial, so our clients can get a quick desktop review of the asset, maybe look at the composition of the roofs, the pool in this instance, if there's tennis courts or how the asphalt looks, etc., and a sense of the neighborhood as well. And then we can scroll down and see some of the facts about the property, the number of units, year of construction, the current occupancy rate. And just to share with you, our data comes from a variety of sources, but two of our primary data sources are Yardi Matrix for property level data and Esri and ArcGIS for demographic and analytic layers. Both are the preeminent providers of that data in their respective fields. Occupancy, for instance, is coming from Yardi Matrix data, as well as USPS return to sender data. Next is one of our proprietary algorithms, what we call the value add algorithm. What this is doing is taking every asset, every dot that you see on the screen in our database and finding its nearest competitors from a proximity and likeness perspective, and then establishing market rent. And the market rent average is always 100 in this field. So if there's a score below 100, it would indicate that rents can rise immediately to meet the market average rent for that comp set. If it's over 100, like this instance, the property's leading the market and maybe not much room to grow rents immediately without further investment. The next line is saying with investment, to upgrade this property, say from a C+ to a B- or a B- to a B, just one step to punch against the next level of competition. How much rent growth can be obtained? In this instance, we're saying 0 because that next level of property is not seeing that much higher of rents. Given the combination of those two metrics, we give it a value add score. In this case, no value add. And I just want to be clear, this is only looking at rents. A lot of our operators know that there are many other avenues to value add, such as operational or management inefficiencies, etc. Next is an algorithm which we find to be the best in the industry, which is the valuation estimate. This, similar to value add, is finding comparable properties and recent sales data, making adjustments between the characteristics of those properties, and then back testing when actual sales occur. And we find in highly transactional markets like DFW, this is within 1 to 3 percentage points margin of error. In less transactional markets, for instance, Des Moines, Iowa, there's typically a 5 to 10% margin of error. So still highly accurate and very useful in identifying the size of property that our clients are looking to acquire. Some really want to play in the $10 to $30 million range. Others want to be in the $30 to $70 million range, for example. Further information about this asset over time, and then we can see this in graphical form over time: average rents, occupancy, unit mix, rent by unit type, area by unit type. Next, I'm going to show how we can filter to the assets that are of most interest to our clients. This is an example of how we start our proactive sourcing campaigns, and we refine them over time with our clients. So we are in the central region, and let's say, for instance, this client is looking for assets between 200 and 350 units. That's where they really like to play. And they like year of construction or vintage of the 1980s and 1990s. And lastly, let's say they really want to buy assets that are valued or priced between 25 million and 50 million. And let's do one more. Let's look at the properties with the highest value add. We'll do high and medium. So there we go. We've trimmed down the universe of assets from thousands in the DFW market to just a few dozen. Now we can select them. $54 assets. We can look at them right in the app. There's a nice screen for that. Or we can look at them in an Excel spreadsheet. Our clients can do this at their desktop and see all of the data here in one spreadsheet. And we can further prioritize these assets. Perhaps the client really wants to look at those assets that have the highest potential for rent growth with further investment. Or they want to start with the newer product, the 90s product first, or whatever other way they want to prioritize. Further, I should mention that we have another algorithm that's called the seller probability score. We have developed profiles for every owner of multifamily assets in the country, about 23,000 of them, identifying how likely they are to sell any of their assets, given such characteristics as how long do they typically hold assets in any given market? What sort of appreciation have they seen on their assets since they purchased? What are their loan terms, etc., to give us an indication of how likely they are to sell. And we'll start by calling those that are most likely to sell first. But at the end of the day, Greg and his team are going to connect with every single one of these property owners in a very tech-focused process and sophisticated process, because it still takes a human to human, of course, to bring them to the table to transact with our buyer as the very best buyer for that asset at the price that they're comfortable with. These are sophisticated owners. They have an idea of how much their asset is worth. Typically, brokers are calling them on a daily basis, trying to list that asset and share with them what it should be priced at. That's an example of the start of our proactive sourcing campaign for this client. We would target these 54 assets in the DFW market and bring them to the table to transact. And that concludes our demo. If there's any questions.
Thanks, David. There doesn't seem to be any other questions as of yet. Is there anything else that you would like to say or add, gentlemen, before we kind of get going to sign off here?
No, just thank you. And really appreciated everyone's time. And you can reach out through numerous different channels, directly online if you are interested as becoming an LP in our syndicated deals. Later this week, and I'll be sending out a follow-up email. We will have an investment room set up for our equity offering. And then if there's any interest in becoming a partner, you can access and go to our website and submit a form to receive a demo by David and the rest of the team.
Thank you so much, Travis and gentlemen. It was a pleasure having you today. Again, my name is Lindsay with Family Office Networks. I actually will be following up with everyone individually. So if there's any other questions, or if I can get you in direct contact with any of the gentlemen from the Offered team, I would love to make an introduction. We thank you for joining us, and I hope you have a great day. Bye-bye.